From WPTV, this is Today on 5 at 11.
The stock market opened this morning in the green. Opened in the green, but that means what's the rest of the week going to bring us?
After the break, we'll get some insight from a financial pro.
And he is going to let us know what we should be doing with our investments right now.
All right, welcome back. 11:22 right now as we take a live look at the big board on Wall Street now. The Dow is sitting at 25,200, off 135 points right now. This after a big finish last Friday when the Dow closed up more than 400 points and a big start earlier this morning at the opening bell. It was up over 100 points and now boom. So you see what we're going to be talking about today here on this Healthy, Wealthy, and Wise Monday. To give us a little more insight into what's going on is Tyler Vernon, CEO of Biltmore Capital in Boca Raton. So good morning. Thank you so much for being here.
Great to be here.
We're checking out all the numbers here. Everybody's doing their thing on their cell phones. You know, it's been a roller coaster ride the past couple of months. Why has the stock market been so volatile lately, and where's it headed this year?
Well, I think coming into the year, well, first of all, last year was a market that is people haven't seen before. And I think a lot of people got used to that. And this is not only a market that hit higher and higher highs, but a market that did it without more than a 3% pullback. We've never seen that in history. So I think a lot of investors got complacent. At the end of the year, valuations were getting extended and people started worrying about inflation. And I think that's really what's caused a lot of this volatility. Higher rates are not good for markets. They've ended bull markets. As we have seen these lows, we've seen a pullback, an uptick from these lows. And as we look later on the year at Biltmore Capital Advisors, what we see is a strong market as we finish. So I think over the next couple of months, we'll certainly see the highs we saw in January. And a lot of this is, there's a disconnect between what's happening in markets and what's happening with earnings. 80% of companies beat or exceeded their earnings targets. We're seeing, as a result of the tax cuts, major bonuses that are happening. Over 4 million people have received a special paycheck as a result of the bonuses. On top of that, we're seeing companies buying back stock in record amounts. Actually, double the amount of stock purchases are happening this year over last year. And companies are spending a lot on their infrastructure. Companies like UPS are bringing on more planes and building more hubs. And all this to us translates into a higher GDP and higher markets now through the remainder of the year.
Well, yeah, I mean, it seems like the economy is in pretty good shape. Last Friday, the jobs report came out. The market went boom. You know, we like positive news. But this has been one of the longest bull markets in history. And people may have gotten, like you said, maybe a little complacent. Maybe they took on a little more risks than they're used to. So does this correction kind of snap people back to, you know, whoa, you can lose a lot. You better be careful.
I wish it did. We're seeing, as we do our reviews with our clients around the country, late last year, people wanted to take more and more risk. And this is very normal in later stages of a bull market. We saw this in March of 2000 at the peak. We saw it in 2006, and we're seeing it now. And to us, you know, at Biltmore, we put together financial plans. We have a specific amount of risk that people take to figure out the return that they need. And what we're seeing is that people are disconnecting from their actual plan, and they just see a market that's up 20%. Even more conservative, they got a 10% return. They say, well, that greed kicks in, that I want this. So I don't think it woke up a lot of people. I would have liked to see a market that lasted a little bit longer with volatility, that swung down more. People that had margin loans against their portfolios, they were forced into margin calls, and that drove people down. They were forced to wake up. But unfortunately, most people out there are taking still way too much risk and concentration with individual stocks.
Well, unfortunately, we're going to have to leave it there. We could talk about this all day, couldn't we? And you do.
I love it.
We appreciate you coming in and telling us about it. Let's check back in with Holland.